Hello everyone, and welcome to this week's Motor Trade Radio podcast, powered by eBay Motors Group, with Philip Nothard and Curtis Hutchinson, bringing you all the chatter that matters.
Well, that's another week, Curtis. Gone.
That is, yeah.
and
where did that go?
I don't know. Where's the first quarter of the year gone? That's flying by, and never a dull day, never a dull week. And we'll talk about it a little bit more about that in a bit. But it's busy times at the minute, and we're approaching the end of the first quarter. It'll be interesting when we do finally see the March figures for new cars and see how the dealers have performed and where those registrations have gone, more importantly this time, yes. Curtis, more than ever. So there's reports that registrations are going back into some of the leasing and rental and fleet market now as manufacturers get up some kind of productivity. So it will be interesting when we see the full month's registrations.
It'll be particularly interesting to start digging down and looking at some of the individual brands as well to see how they performed over the course of this quarter, and especially Mercedes-Benz, who have gone all agency. It'll be their first quarter as under agency, won't it?
Very much so. And we will be talking about manufacturer performance in a slightly different way on today's show. But we must talk about the midweek interview that we've had this week with our good friend Steve Young from ICDP, who gladly came back on and gave up some of his time to talk about a few things happening in the industry. And we had a bit of a joke with him about his blogs, that he's never short of a story for his weekly blog. It's a case of picking what topic he wants to speak about rather than trying to find stories to talk about in his blogs, wasn't it?
Yeah, exactly. And the full interview, which, as you mentioned, is available on your podcast feed. We do actually cover a lot of ground, but it's all very, very topical, isn't it? Because we talked to him about the Jaguar network hull that we discussed on last week's podcast, as well as Lithia Motors buying Jardine and what that means to the UK in terms of Lithia, big US giant, buying a sizable group here, and a lot of the commentary about UK groups being undervalued. So we do actually talk to Steve about that, as well as the Chinese brands that are coming to the UK following the debut only last week of BYD. So lots in there.
Yeah, definitely. And talking about what's happening in the market, don't miss next week's monthly catch-up with Darren Martin, Director of Valuations over at Cap HPI. We'll be chatting to him about what's been happening in the month of March around valuations. I'm sure there'll be some discussion around petrol, diesel versus electric vehicles, again, as there is every time recently. But that will be in your podcast feed next week, and hopefully he'll sort of talk to you through what's been happening in the month of March, but more importantly, what to expect over the sort of next weeks and months following the month of March, and where he sees the market heading in terms of used vehicle values following what's been happening in the first quarter of this year.
Motor Trade Radio podcast, powered by eBay Motors Group.
Okay, headlines this week are from AM, Motor Trader, Motor Trade News, and the Financial Times, starting with new favourite car brand named in latest NFDA Dealer Attitude Survey. As the cost of living crisis bites, dealers are cutting spending on staff, stock, and premises. We look at Pendragon's full-year profits, which are down as it looks to renew frayed links with carmakers. Also, ex-fleet EVs are taking twice as long to sell to dealers as ICE vehicles. And finally this week, why dealers value physical auctions again.
So as you say there, we're starting off with the results of the NFDA Dealer Survey. And this is with AM we're talking about this time. So Kia ends Lexus 7 survey reign as UK car retailers top rated OEMs partners. So a little bit of a shift around within the performance of this results this time, wasn't there, Curtis? With, like you say there, that Kia takes that top spot away from Lexus that have had it for a while now.
Yeah, so Lexus have held that spot for, well, over the course of the last 7 surveys, as you mentioned, and it does feel as though they've been there pretty much forever. But this is a really interesting turnaround for Kia. So they were rated number 1 overall, and the key question in this survey, I mean, there are over 20 questions that they cover a lot of ground in the survey, and I do urge you to go over to the NFDA website and download the full reports, because it's very detailed and it's a mine of information. But the key question is, how would you rate your manufacturer partner overall? So the ratings are from 1 to 10, and Kia, as you say, came top with a score of 9.3 out of 10. So that nudged Lexus off the top, and it's a good result. The average this year is 6.5, which I think is the same average as last time the survey was done 6 months ago. But I think what's particularly notable is that this survey has the highest ever response rate of 70%. So that equates to just over 2,600 responses.
Yeah, that's a good response, and I suppose you talked about the good news. I'll talk a little bit more about the bad news, I suppose, Curtis. But Mercedes-Benz actually slipped out of the top 3 with a score down 0.3 points in the period, and then you've got Stellantis. Stellantis did get the headlines in some of the trade media on the back of the results, because they do dominate the bottom 10. Unfortunately, and saying that the bottom rankings, its 2 makes preparation to introduce agency model retail after 6 months delay to implementation. So not so great for the Stellantis brands in this survey, Curtis.
It really is a disappointing showing for the Stellantis brand. So the bottom rated overall was Citroen, scoring just scoring just 2.7, down from 4.3. But as you say, they do dominate the bottom 10, because Citroen is followed by Vauxhall, Fiat, Peugeot, DS, Jeep, Abarth and Alfa Romeo. They're all in the bottom 10. The only non-Stellantis brands there are Jaguar and Seat.
Yeah, and there's a lot of detail in this survey, and it's, as Curtis said earlier, it's well responded, and the response rate is getting better and better. And the FDA do a lot of work with the manufacturers and with the dealer networks to get the response, because it is of value to the OEMs to understand how the network is feeling about them, and what they can do work with. So again, if you haven't seen it, then I would head over to the NFDA website and have a look at it in a little bit more detail. So there's some interesting information in there, and particularly when you start to drill into some of the questions, and you probably relate it. You'll read a question, go, I know why that is, or I know why that is. That makes a lot of sense. I understand this. And there's different strategies taking place within the OEMs. A lot of the transition to electrification, consolidation of the network, the agency model and things like this, that are all now starting to change attitudes a little bit, depending on where that OEM is in terms of that strategy to market. So as I say, do head over to the full report and you'll get the full details on that.
Next headline is from Motor Trader, and it is dealers cut spending on staff, stock and premises. So probably no big surprise on sort of all 3 of those areas, really. And this is based on research that was carried out by Close Brothers Motor Finance. And the Motor Trader store really does focus on this, because it found that 78% of dealers singled out inflation as the biggest problem they face, hence the various cuts. So nearly 1 in 5, 17% of dealers are spending little on staff numbers, and 13% plan to cut back further, where in contrast only 1% are spending heavily on staff numbers, and the same number plan to increase spending further. And those terms like spending little, spending heavily, they're very much from the survey. That this is what the various dealers have been asked. Are you spending a little? Are you spending heavily? So this is how it's panned out.
And speaking of stock, a fifth of the dealers, 22%, are planning to cut heavily spending on stock, compared to 16% who are planning to increase spending, whereas 45% dealers also stated they are going to continue spending little on upkeep on premises in order to save money. So as Curtis said there, the complete set of the questions is actually in the release there on motortrader.com, and it does show the complete set of questions and responses, and quite interesting on some of these, isn't it, Curtis, where you may not think where there is sort of investment. I mean, you look at social media, 42% continue spending little, whereas 18% said not relevant. So 18% don't see social media as a relevant spending area on their business. So quite interesting. Whereas 56% not interested in subscriptions, compared to 25% spending very little, which I suppose you can understand some of that. But sponsorship is down, isn't it? There's not much spending on sponsorship at the minute either.
No, or advertising, 5%.
Well, yeah. But some very interesting reading there, and as you alluded to there, Curtis, that upkeep of premises. I suppose that probably touches on the interview with Steve Young.
Yes.
A little bit on that one, in terms of how much you're going to spend on your premises with everything going on around the world of consolidation and shift to agency. Maybe that has had a bit of a bearing on the results of this survey.
Yeah, especially if those premises happen to be a dual arch.
Careful there, Curtis. I'll leave you to that one. But no, I say, great little bit of insight there, a little short survey that Close Brothers have done with the network, just to try and gauge where we are. And obviously this week we've had the we've had the budget last week, and we've got the aftermath of what that means potentially in terms of that investment, capital investment. Inflation has come out this week and gone up again, which goes against what they did expect. So there's probably a lot going on around that in terms of spending. So I would urge people to go and have a look at the full story in detail and see if it relates to anything that you are doing in the market.
And next story is from the Financial Times, and it's Pendragon looks to renew frayed links with car makers. Now, the story emerged from Pendragon's full year results, which were covered pretty extensively in the dealer press. But I thought this story was particularly interesting because they've interviewed Bill Berman, the chief exec of Pendragon, and really got his views on the business that he inherited when he took over, and how he's trying to turn things around at the moment. So maybe if we just start with those full years. So full year results for the calendar year to December 2022 saw pre-tax profits down to £57.6 million. And that was a drop of 30% from £83 million in 2021. But it was actually a smaller drop than had been expected. And Pendragon said inflation and higher costs in its used vehicle business pushed down those profits. And if we look at revenues were up 5% at £3.6 billion, while the company said orders in the first 3 months of 2023 were actually very strong. But just going back to some of those comments from Bill Berman, because they are interesting, because they do shed some light on what he believes has been the sort of lasting impact on the group since he joined in 2019. And he's saying that the fast expansion that the group had been under had seen it lose a number of key brands. And maybe it didn't have such close relationships with its OEM partners that it should have had and indeed needed. But over that period, it did lose the likes of Volkswagen and Audi, and it was focusing heavily on its used car business, especially the evolving car store multi-franchise supermarket chain.
Yeah, and it does cite that the group has said that they're working, and we mentioned it on last week's podcast around the BYD, the Chinese electric vehicle manufacturer, that they're saying that that's the first step to rebuilding its reputation amongst car makers after years of declining relationships. And it goes on to say that as the company reported a better than expected 30% drop in profits because of higher costs, that Bill said he was trying to win back automakers that stopped working with the business under his predecessor's long-time boss. But he does get a little bit more direct in the story, doesn't he, Curtis? And
he's very direct.
Yeah, I mean, so he actually stated that we had officially pissed everybody off, said Berman, who joined the business in 2019, while relationship breakdowns often have been a blame on two sides. This was on all of us, he told the Financial Times. So, very direct, but obviously focusing on that rebuilding of relationships with the manufacturers, whilst continuing. He does cite that within this release here that used car sales will continue and remain tight. Because of the availability of used cars with the shortage of production that we've seen over the last 3 years. And predominantly the Pendragon has been reliant significantly on used car volume, hasn't it, for many years now.
Yeah, and he does go on to say that we have pivoted our strategy to talking about growing our new vehicle representation. And he goes on to say that BYD is part of that. And the story does infer that there are other Chinese brands being considered as well, which would make perfect sense. Now that they are representing BYD, they've opened the first couple of dealerships. But he also talks about Pinewood because of course, just a few months ago, it looks though Pinewood was being considered as a separate entity when Hedin were looking at buying the group. But he does make the point that Pinewood is the jewel in the crown, or the crown jewel, as he says. And it always has been, hasn't it? Pinewood has been such a major part of the business. Maybe it wasn't shouted about so much in the past, but it is a significant driver of the business. And he does infer that it's integral to the business, and he does actually say the way that it's incorporated into the business is better. It's better that way that it is.
Yeah, it's a key strategic part of a driver of their business, and always has been. Every time you see the financials, that Pinewood unique advantage over its competitors is quite strong for the business. So it'll be interesting. And back to the Steve Young interview and talking about obviously acquisitions and growth and share values of these businesses, and we do touch on the Pendragon position and obviously the Lithia attempt at acquiring it and the Hedin attempt at acquiring it. And obviously in the middle of all that was the Pinewood. Would Pinewood go with that sale or would it be broken away from? So I want to keep a close eye on there, but very much, if again, like I keep saying, if you've not seen that story, then it's a great story there in Financial Times by Peter Campbell. A little bit more detail than you've seen in some of the trade media. But sticking with large groups and to a degree the US, because Bill Berman is from the US, and the story has come out this week. And just to put a bit of context around when we're talking about numbers here, and this again was in the Financial Times and subsequent in other media that picked it up from there. But online auto retailer Carvana to attempt restructuring of $9 billion debt load. So that's $9 billion that we're talking at here. So, Carvana's been in the headlines a lot recently against their performance. And again, when you're struggling with used car volumes, there's this online versus physical, and everything else that's taking place. When it's at this kind of scale, we are talking significantly big numbers. Bearing in mind the business sold 425,000 cars in 2021, and that was up from 245,000 in the year 2020. Now, that figure is a big figure, but actually you can see when you picked it up, didn't you, Curtis, in the story? I mean, the drop in market value is huge.
It is, yeah, because the market capitalization for Carvana soared to just under $50 billion in 2021. And this story says that the market value now stands at less than $2 billion. So, and I don't recall seeing a story, financial story in the FT before where every figure is a billion, isn't it? It's multi-billion dollars. That there is nothing less. But it just shows the scale of the fall and the problems that Carvana faces with this restructuring plan.
Yeah, there's a lot going on with the Carvana, and it's a significant business obviously in the US there. But they're working through it and trying to get the capital to restructure and get the way through the other side of it. And I'm sure it's not quite as bad as the Kazoo story that we keep talking about over here in the UK.
You're listening to All the Chatter That Matters on Motor Trade Radio, powered by eBay Motors Group. This is your weekly one-stop shop for all the biggest car retailing headlines from across the media, available on demand wherever you are on your podcast feed.
Next up is an extract from this week's interview with industry guru Steve Young, MD of ICDP, talking about last week's acquisition of Jardine Motors by US giant Lithia Motors. Now, Steve, the other big story from last week was confirmation of the acquisition of Jardine Motors by Lithia Motors, who are America's biggest franchise dealer group. Now, this actually followed months of speculation. We kind of knew this was on the cards, and also its failed move on Pendragon. So, do you think this move will actually open up the UK to more US and overseas buyers? And in last weekend's podcast, we quoted Lithia's CEO, who commented on the deal being, in his words, more affordable than we would typically find in the US. So is it making UK groups more attractive to the likes of Lithia and other US players?
I think the exchange rates always become a factor in terms of an external buyer, and that is playing a part at the moment. But even looked at domestically, if you look at automotive retail compared to other retail sectors, then it is undervalued. It's not an attractive stock. I'm invited sometimes to speak to investors, to investment funds, and so on about automotive retail, and they still find it sort of uninteresting, not something they want to put their money into. And so even looked at from a UK perspective, they're undervalued. When you put a currency difference in there as well, then obviously there are periods when it becomes even more attractive for an overseas buyer. And that's sort of where we are at the moment. But I don't think that Lithia is buying because exchange rates or anything else. I think they've reached the point where they want to follow people like Penske and Group 1 and look further afield, and the UK is obviously an easy first step for a US group in terms of the language, but the general operating environment and the size of the groups here means that you can make a single purchase and immediately have scale, and that's the critical thing in cross-border acquisitions, is that getting synergies across border is difficult. So you need to get the synergy domestically, and that really means as a buyer then it's a single hit, get the scale, and then you can add on, and then you potentially make another scale purchase in another market. But you don't want to buy in 2s and 3s, and obviously Jardine isn't a 2 or 3 shop dealership.
And I think in your latest blog, you actually questioned whether or not Lithia would make further purchases in the UK, once Jardine beds in. Do you think that is likely?
Yeah, I'm sure that they will. I think that they, and when we say bed in, I'm not even sure that it will necessarily be that long, but they clearly had an appetite for something bigger and something more diverse in terms of the brands that were represented when they were looking at Pendragon. And Jardine is now very much focused at the top end of the market. So there's lots of opportunities to pick up groups who are focused on Audi, BMW, Mercedes, and the volume brands, the Volkswagen Group brands, Toyota, and so on. They were prepared to take on those brands if they bought Pendragon. So I think they will make more acquisitions.
And how much of this will be relative, in terms of the that conversations with the OEM at a global level of partnership? Because this is sort of Lithia is an expansion of representation that they've already got in the US. Do you think, because obviously you mentioned the exchange rates and things like this, but actually there'll be potentially global conversations of partnerships between these US businesses and global OEMs, won't I suspect?
To a limited extent, I think, yes. I mean, I'm aware of situations where a manufacturer has been looking for a more sophisticated investor to enter into a market to basically up the standards. And so they've approached a favored investor and said, look, would you please look at this market? You might want to look at this particular group. We're not really in that situation in the UK insofar as the standard of retail here is extremely high, and I would happily argue with anyone, including Lithia Motors, that they're going to learn a lot by buying into the UK market. But it always helps. If you have a relationship at headquarters, then when you then come to make a deal in another market, then if there's any wheels that need oiling, maybe entrenched positions of the NSC staff about particular favourites, then you can overcome that. But most of these sorts of approvals and discussions are at the local level, but having top cover helps.
Well, as always, I mean, Steve, we can probably chat to Steve for hours, can't we, on subjects within the sector? But that is a small clip from the longer interview that we did with Steve Young that's on your podcast feed from earlier in the week there, that, as we said at the start of the show, a little bit more detail around the JLR news that's been hitting the headlines recently, and obviously around the BYD and EV new entrants coming into the UK market and what that means. But they say there, Steve sharing a bit of his view on the Lithia acquisition of Jardines and on UK valuations of the automotive sector, and why sometimes it's just that little bit of a challenge to get the investor market understanding the value of the UK automotive sector.
Yeah, I mean, he really does shed some light on that, because we all know within the industry what the value is, but it's not seen necessarily outside of the industry, is it, when it comes to investors looking in from the outside?
No, and we do touch on it, exchange rates and valuations and relationships in the global market between some of the international and global businesses, and obviously, with Penske and Auto One in the UK, there's a lot going on in that space, and like we do touch on in the interview, there's still 9 months of the year left, Curtis. So anything could happen, couldn't it?
And probably will.
Probably will, yes. So anyway, touching on EVs there a little bit, and we're heading over to Business Motoring, and ex-fleet electric vehicles taking twice as long to sell to dealers as ICE vehicles. Now, this is a story coming out of Epics, obviously, who are a supplier to the dealer network, and obviously looking at probably relating to the caution towards dealers' appetite towards stocking EVs. And we mentioned right at the start of the show that next week we've got obviously Darren Martin coming back on next week to talk about the March performance. And really, EV and the drop in EV values has really dominated that chat every month for a few months now, hasn't it, Curtis?
Yeah, definitely. And this story is particularly interesting because this is really where the EV volumes are coming from, because these are all defleeted EVs. So the figures come from Epix's One Link disposal network, which has been managing defleets for a number of years now. So it has amassed a lot of data, and it does enable it to pinpoint these trends. So what it's found is that petrol cars and vans are taking an average of 10 days to sell on the One Link platform. Diesel taking 11 days, so that's just one more day. But EVs are taking 25 days. So the trend remains the same when the data is split down into online and physical auction sales. When sold online, petrol takes 5 days, diesel 6, and EV 11, whereas at auction, petrol and diesel both the same at 15 days and EVs at 33 days. But they do make the point within the story that on the platform, on the One Link platform now, 1 in 6 vehicles are EVs, and that represents a huge volume growth. And this is what we're seeing in the sort of wider sector, isn't it?
Yeah, I mean that's key. I mean that's obviously what is driving some of the depreciation that Darren talks about on a monthly basis, because it's about volumes coming back into a market, into a used vehicle part that aren't quite ready, and the dealers are nervous and cautious towards stocking battery electric vehicles, because in many ways the used car buyer don't get any tax benefits from purchasing a battery electric vehicle. They face all the challenges around charging infrastructure and range anxiety, and in many ways, previous to a lot of the downward movements that we've seen recently, they were paying a lot more money for battery electric vehicles in some cases compared to the equivalent combustion engine. So you can kind of see where the dealer market are nervous. But I think since a lot of the drops though in values, we are starting to hear and see a lot more activity around used battery electric vehicles. The dealer network are now starting to see the value. They're starting to understand the customer conversations they need to be having on battery electric vehicles, because these things are, some of them are looking very good value now.
Yeah,
you see Nissan Leafs at sort of £17,000 for 2-year-old Nissan Leafs. You're seeing 2-year-old Teslas now at £25,000. Suddenly, it's a reasonable used car proposition for people. So yeah, it's going to be interesting. I think to the point of the story there that dominating in terms of the volume of vehicles that are now landing on the platform, are taking a little bit longer. So it's changing the profile of their business in many ways.
Yeah, and there's an interesting quote here from Tim Meadows, who's Chief Operating Officer at Epics, who says, ultimately, the speed at which they are selling, as in EVs, could conceivably be viewed as a positive, as there is every chance that excessive supply and demand for EVs will switch places several times before the market reaches a point of relative stabilization. And he goes on to say today's situation could change quite quickly, and I think he's absolutely right there.
Yeah, definitely. So again, it'll be I'm sure there'll be a lot more coming from that as we move forward. And the final story today comes from Motor Trade News, and The header is, I quite like the header of this one, is a game of chess. Why dealers value physical auctions. I suppose I've got a bit of a bias towards this one, Curtis, as well in many ways. But this is from Chris Wright there at Motor Trade News. Now, this is basically from a survey that Motor Nova Finance has done, and basically that the results are that they preferred physical auctions to online auctions from the results here.
Yeah, I mean, this is the conclusion of this research, and it's some interesting bullet points that have been pulled out from the survey. So the reasons behind this are that dealers can actually view vehicles, look at their grade and condition, that would usually be filtered out with initial online searching of catalogues. So it really is down to the nitty-gritty of being in auction halls and being able to view these vehicles in the metal, because it goes on to say that visual checks and doors open to pick up any odor, identify any illuminated warning lights, and conduct an overall interior inspection. They're all valued by dealers, as well as audible checks to assess any unexpected engine exhaust or transmission noises. So we're pretty much back to where we were before the lockdowns, aren't we? According to the results from this survey.
Yeah, and I think, to put context in some of this, I think there's a place for both, and that's what a lot of the operators believe in terms. I mean, we hear the word digital, that physical and digital presence in the market. That that nearly new 0 to 12, 0 to 24 month vehicle. Do you need to see it, touch it, smell it in going to the story here? Literally smell it. Is there a need for that? Is there a need for some on some vehicles? I think there's a tale here that some of that older, higher mileage age product, yes, there's still a want from many dealers to go and touch and see those vehicles. There's also a want from some dealers to be in a networking environment, to see colleagues within the industry in a physical auction environment, but also digital offers you that scale, that efficiency of being on multiple auctions at the same time in a virtual environment. So it depends on the profile of your stock, profile of what your buying habits are, and where the cars are in terms of location and access to them. So I think there's a bit of both there, but clearly the story here is that there is still a demand for physical auctions to the right customer in terms of buyer for the right type of vehicles.
Yeah, and I thought the most telling result was that physical auctions present an opportunity for dealers to study the competition. So not necessarily look at the cars or solely look at the cars, but study the competition, understand their buying power, and see what stock is bought. So obviously a very, very important part of the whole physical auction process, isn't it? It's seeing what other dealers are doing.
And it's not, we talk about it a lot, don't we? We this omni-channel, we talk about in the dealer, whether physical versus virtual. We conversations we've had for how many years now, Curtis, of Kazoo entering the marketplace. So I think there is a blend here, and this is clearly saying that there's still that demand for that physical engagement, either for the car or the networking, or as to your point there, assess the competition. But I think that's it for this week, Kurt. I mean, we've covered a lot here, and again, referring to the Steve Young interview there. If you haven't listened to the whole interview, I think it's about 35 minutes long. Check your podcast feed and catch up with the full interview there with Steve Young, covering various aspects of the big stories, the big topics of the sector. And as always, we've got the full stories. Check the full stories that we've discussed this week, and the newsletter will be out as you'll hear at the end of today's podcast.
But that's all for now. Many thanks for joining us on the Motor Trade Radio podcast. We're back during the week with our special interview with Darren Martin, so do look out for that. Until then, it's goodbye from me.
And it's goodbye from him.
You've been listening to Motor Trade Radio Podcast, powered by eBay Motors Group. We'll be sharing all the links from this week's headlines on Monday morning. So to make sure you receive them, just subscribe to the free newsletter on our LinkedIn page. Just search Motor Trade Radio Podcast.